Millions of people in the UK are saving every month, confident their money is protected. Yet 2026 is shaping up to be the year when savings stop feeling safe. New laws are quietly moving through the system, and once they activate, the cash sitting in banks, ISAs, pensions, Fintech apps and investment platforms could lose value faster than anyone expects. Your money might not be taken away, but the rules around it will change, and change always has a price. Before these laws arrive, every saver needs to understand what's about to happen and why waiting could cost the most. Number 1. The Finance Bill 2025-26 and the new restrictions on savings reliefs. The first major change that could impact savings in 2026 is the tightening of reliefs under the Finance Bill 2025-26, especially Business Property Relief (BPR) and Agricultural Property Relief (APR). For decades, these reliefs protected certain assets from large tax deductions during inheritance or wealth transfer. From 6 April 2026, the rules are expected to shift, narrowing the eligibility criteria and reducing the exemption levels. This means that assets which previously passed on with minimal tax could now be counted at a much higher taxable value, including investments people rely on as part of their long-term savings strategy. The new bill aims to close what the government considers loopholes, but ordinary savers may feel the ripple effects. The biggest concern for families is that savings parked in tax-efficient asset structures may no longer remain fully protected, especially if those savings are tied to private companies, small businesses, or land. People who use these reliefs to secure their future could face increased tax exposure at the very moment those savings were supposed to support retirement or dependence. The bill also proposes more aggressive reporting and valuation requirements, meaning more paperwork and stricter compliance to preserve even a portion of the reliefs that remain. For anyone planning generational wealth transfer, this shift requires serious attention because the financial impact could be much greater than expected. There are practical steps that viewers can consider in light of this new direction. Audit all assets that currently depend on BPR and APR and evaluate whether your long-term savings depend on them more than you realized. Review ownership structures and investment portfolios to see if asset categories now carry a new tax risk under the 2026 model. Consider moving a portion of savings to tax-sheltered vehicles that are not affected by relief tightening, such as diversified ISA-eligible investments, to reduce exposure. The earlier adjustments begin, the less likely financial shocks will occur at the moment when savings are most needed. Number 2. Enhanced HMRC data collection on savings interest. The second upcoming change that could silently affect millions of savers in 2026 involves expanded HMRC data collection on savings interest. Under the new system, UK banks, building societies and investment platforms will be required to share far more detailed information about individuals' savings activity, including national insurance numbers, total annual interest earned, and linked accounts. The government plans to move away from self-reporting and into an automated model where HMRC calculates and issues tax bills directly based on the data received. This means people who previously assumed their bank interest was too small to matter may suddenly receive tax notifications they did not expect, especially if they hold multiple accounts that collectively generate higher interest than they realize. The core concern here is that while the move aims to reduce tax evasion, it also removes the blind spots that allowed savers to remain under the threshold unnoticed. Any interest outside ISAs will become highly visible, and many savers may cross the personal savings allowance (PSA) without realizing it, particularly after rising interest rates boosted returns on cash savings. Individuals who rely on high-interest savings accounts, fixed deposits or premium bonds as part of their financial planning may experience a noticeable reduction in the net value of their annual savings once tax payments are deducted. The process will be automatic, meaning mistakes or miscalculations will require the individual to challenge HMRC rather than handle reporting themselves. There are ways to reduce the risk of unexpected tax bills when this new rule arrives. The most effective step is re-evaluating the balance between taxable and tax-sheltered savings, especially if most interest currently comes from non-ISA accounts. Consolidating savings into fewer accounts can help monitor interest more clearly, and shifting more funds into cash ISAs, stocks and shares ISAs, or employer pension schemes may preserve a greater portion of earnings. Periodically estimating total expected interest across all accounts can provide clarity before HMRC takes action, creating a smoother financial outcome and reducing unpleasant surprises when tax season arrives.
Number 3. Reduction in tax-free savings allowances and crackdown on non-ISA interest. The third major financial shift expected in 2026 is the potential reduction of tax-free savings allowances, especially for savers who rely on interest-earning deposits outside ISA accounts. For many years, the Personal Savings Allowance (PSA) has protected a portion of earned interest from taxation, allowing basic rate taxpayers to receive up to £1,000 in interest, without tax deductions. Reports suggest that this allowance may be reduced significantly, and the government is preparing stronger enforcement systems to ensure that every pound of taxable interest is accounted for. The intention is to push more savers toward regulated investment products rather than allowing money to remain in high-interest cash reserves without generating tax revenue. The change primarily affects people who prefer the security of fixed deposits, high-interest savings accounts, or premium bonds, rather than risk-based investment platforms. Once the new PSA threshold is lowered, a larger percentage of ordinary workers and retirees will begin paying tax on interest that previously remained untouched. Even individuals who do not consider themselves high savers may notice an impact if interest rates remain elevated. Someone holding several savings products across multiple providers will be especially vulnerable because combined interest can exceed the new threshold quickly. This shift means that cash-focused saving strategies could become less profitable, prompting many to rethink where they store their money. There are steps that viewers can take to reduce the impact of these changes once they arrive. Moving a strategic portion of savings into cash ISAs or stocks and shares ISAs protects interest from taxation and provides a more predictable long-term result. Monitoring the yearly growth of interest before it accumulates beyond the allowance can also help preserve the value of savings. For individuals who prefer low-risk products, splitting deposits between ISA-eligible platforms and traditional savings can maintain security while adapting to the new financial landscape. Planning ahead rather than reacting later keeps control in the hands of savers rather than the tax system.
Number 4. The 2026 Buy Now, Pay Later regulations and the hidden pressure on savings. The fourth change affecting money security in 2026 is the arrival of full regulatory control over Buy Now, Pay Later services. Starting in 2026, providers like Klarna, ClearPay and PayPal will fall under stricter oversight from the Financial Conduct Authority. The goal is to protect consumers from overspending, but the deeper financial consequence is that BNPL will become more tightly connected to credit files, interest charges and penalty tracking. Once these rules activate, BNPL purchases will no longer remain informal short-term installments. Every delayed payment could be recorded as formal debt, creating a more aggressive repayment structure that places pressure on monthly budgets and long-term savings security. This reform matters because BNPL has become a common spending method for essentials, fashion, electronics, and even groceries. When the 2026 model takes effect, companies will be allowed to impose new late fee frameworks and interest charges approved by regulators. The moment repayments become harder to manage, households may experience rapid cash drain, reducing the ability to save or maintain emergency funds. Even those who pay on time could feel the impact if their credit risk score changes, because insurance payments, mortgage offers, and bank interest rates are influenced by credit behavior. A small BNPL backlog can now have ripple effects across overall financial stability. There are key actions viewers can take to protect savings before these rules begin. Tracking exactly how much BNPL borrowing occurs each month can prevent spending from slipping into long-term debt. Replacing BNPL habits with zero-interest budgeting tactics, such as automatic savings envelopes or prepaid spending categories, can remove the need for installment spending altogether. Reviewing subscription payments and non-essential purchases can also free up disposable income that BNPL previously absorbed. The less a household depends on installment spending, the more resilience it builds against sudden fees and long-term interest traps. Preparing now strengthens the savings cushion and reduces the likelihood of future financial strain. Number 5. The FCA's 2026 expansion of non-financial misconduct rules and its effect on savers' costs. The fifth upcoming shift that can indirectly impact savings in 2026 is the Financial Conduct Authority's expansion of non-financial misconduct rules across a wider range of financial services firms. From September 2026, misconduct categories such as discrimination, harassment, or bullying within workplaces will become grounds for regulatory penalties, leadership dismissals, and business licensing issues. This move is designed to establish safer and more ethical environments within banks, investment firms, insurance providers, and asset management companies. While this upgrade supports consumer protection and corporate accountability, it comes with the side effect of increasing internal compliance costs for firms, which historically leads to higher charges for everyday customers. Financial companies generally handle increased operating costs by adjusting service fees rather than sacrificing profit margins. This can show up in multiple ways: higher management fees on investment platforms, reduced promotional interest on cash savings accounts, new charges for account maintenance, or more restrictive terms for free banking options. When compliance and legal departments expand, customers indirectly pay for the restructuring. That means even people who avoid complex investment products could notice a slow erosion in the benefits they receive from their savings institutions. Lower returns and increased account fees create a combination that weakens the growth of savings, especially for individuals relying on steady and low-risk financial products. There are defensive moves that ordinary savers can begin planning ahead of this change. Regularly comparing fees between banks and investment platforms can prevent unnecessary losses caused by gradual price shifts. Building a diversified savings approach, including a mixture of ISAs, government-backed bonds, and employer pensions, reduces reliance on any single provider that may increase charges. Paying close attention to account changes sent through email or mobile notifications ensures that fee increases are not overlooked. When firms adjust pricing after the new rules take effect, savers who actively monitor their accounts will be in a better position to switch providers quickly and protect long-term savings growth.
Number 6. New safeguarding and audit requirements for payment and e-money firms. The sixth major change that could affect savings security in 2026 is the new safeguarding and audit framework for payment providers and e-money firms, including platforms such as PayPal, Revolut, Wise, Monzo, and similar digital wallets. Beginning in May 2026, these companies must meet stricter rules on how customer funds are stored, reported, and protected. Regulators are introducing mandatory third-party audits, faster segregation of customer deposits from company operating funds, and stronger financial reserve requirements. Although the reform is meant to prevent collapses similar to cases seen in other financial markets, it also triggers increased operational costs and could create new limits on how users access and withdraw funds during high-risk periods. This change directly touches savers who keep large balances within fintech platforms rather than traditional banks. Digital wallets became popular due to high flexibility, low fees, and fast transfers, making them an alternative to conventional savings accounts. Once the 2026 model takes effect, payment firms may introduce withdrawal limits, monthly service charges, or delayed payout systems during audit cycles, which could disrupt savings that people rely on for emergencies. Funds held in fintech accounts do not always benefit from the same protection as those in high street banks under the Financial Services Compensation Scheme, creating additional risk if firms adjust their business models or experience financial strain during transition. There are smart steps viewers can take to minimize vulnerability. First, avoid treating payment apps as long-term savings storage unless they qualify for full deposit protection. Moving a portion of savings from digital wallets to regulated ISA-eligible accounts or FSCS-protected banks can maintain liquidity and reduce uncertainty. Maintaining smaller working balances in fintech apps for daily transactions while keeping larger sums in protected accounts improves financial reliability. Periodically reviewing terms and conditions from payment service providers will help identify early signs of fee increases, transfer restrictions, or new account rules.
Preparing now builds a more secure structure for managing cash across traditional and modern platforms.
Number 7. Frozen income tax thresholds and their silent impact on savings growth. The seventh shift affecting financial stability in 2026 is the ongoing freeze on income tax thresholds until at least April 2028. This policy does not raise tax rates directly, yet it gradually pulls more workers into higher tax bands as wages rise with inflation. The outcome is that a growing percentage of income becomes taxed at higher levels, reducing disposable earnings and decreasing the amount people can comfortably save. The freeze also affects the personal savings allowance because once a saver moves into a higher tax band, the allowance automatically shrinks. Someone entering the higher rate bracket will see their allowance drop from £1,000 to £500, and those pushed into the additional rate bracket lose the allowance altogether. The impact is quiet but powerful. Even if salaries only rise for cost of living reasons, the taxpayer may move into a bracket that forces a larger share of earnings to be diverted into government revenue. As take-home pay becomes reduced, the long-term effect is a gradual contraction of emergency funds, retirement savings, and investment contributions. Savings that were once growing comfortably might now plateau or decline as higher taxation erodes the spare income available for future planning. At the same time, inflation continues to raise the price of essentials, meaning people must stretch the remaining income further while savings growth stalls. This financial squeeze becomes most visible after a year or two, rather than instantly. There are strategic ways to soften this pressure and preserve savings despite threshold freezes. Increasing contributions to ISA accounts, employer pensions, and salary sacrifice schemes can legally reduce taxable income while protecting more of the money being earned. Reviewing monthly budgets and shifting even small sums automatically into protected savings vehicles creates consistency and reduces financial drift. Consider limiting reliance on savings accounts that generate taxable interest if the allowance is shrinking, and explore options that provide tax-sheltered growth over time. A proactive structure prevents the threshold freeze from quietly consuming the financial progress built over many years.
Number 8. Inheritance tax and pension fund changes, bringing retirement savings into estates. The eighth law projected for 2026-27 is the adjustment to inheritance tax, IHT, rules that could bring pension funds into the taxable estate upon death. Historically, most pension pots fell outside the estate, meaning families could receive them without heavy tax reductions. The reform under review would redefine pension money as part of the estate, creating a new tax charge for dependents and beneficiaries. For many people, pensions represent their largest form of long-term savings, so the shift has major implications for intergenerational planning. Wealth that was intended to create stability for family members may shrink significantly once IHT is applied. This change could be especially impactful for individuals who rely on pensions not only for retirement income, but also for legacy planning. Under the proposed model, beneficiaries may inherit reduced pension values after taxation, limiting their ability to use inherited funds as originally intended. Families that planned to transfer financial security across generations might have to rethink how their pension savings fit into estate management. The greatest concern is timing, because the tax would apply after death, leaving relatives to face the financial consequences without much flexibility. The emotional and financial burden could be compounded during an already difficult period. There are methods to prepare before these pension adjustments become active: reviewing pension beneficiaries, evaluating lump sum withdrawals before taxation applies, and shifting part of retirement savings to tax-efficient vehicles outside the estate can help preserve value. Consulting providers regarding drawdown options, annuity conversions, and ISA-based legacy strategies can add additional protection. Keeping pension balances below thresholds that trigger higher tax rates may also reduce exposure if structured carefully over time. Acting before the rule takes effect provides more control than reacting after it is implemented, ensuring that savings intended to support loved ones retain as much strength and value as possible.
Number 9. Restrictions on AIM-listed shares and alternative investment reliefs. The ninth financial shift, expected in 2026, is the restriction of tax reliefs for AIM-listed shares and similar alternative investment vehicles. For years, these investment options played a unique role in long-term savings strategies because they qualified for certain reliefs that lowered inheritance and capital gains liabilities. Under the new 2026 framework, many of these reliefs are scheduled to be reduced or removed, meaning assets that previously offered generous tax advantages may become significantly more expensive to hold. This adjustment targets what policymakers view as high-value tax shelters, but it can also affect individuals who rely on these investments not for speculation but for stable long-term savings growth. The most noticeable impact arrives when investors attempt to transfer, sell, or pass down these assets. Without the previous relief protections, AIM-listed shares can generate larger tax bills, reducing the net value of the investment. This creates a new layer of risk for individuals who diversified into private equity or small-cap markets specifically to preserve wealth. The consequence is not limited to the wealthy. Many long-term savers placed retirement money into AIM-listed structures because they offered a blend of accessibility and tax efficiency. Once the protections shrink, returns that once felt rewarding may be offset by taxation during major life events, including inheritance, property transfer, or portfolio liquidation. There are practical strategies to ease the pressure of this transition. First, reviewing portfolios now rather than after the law becomes active can identify whether AIM exposure currently holds more weight than intended. Diversifying into tax-sheltered growth options such as stocks and shares ISAs, employer pension schemes, and government-backed bonds can reduce vulnerability to relief withdrawal. Rebalancing investments gradually rather than through sudden sell-offs prevents unnecessary losses while maintaining long-term growth potential. Keeping a clear record of purchase dates, valuations, and capital gains helps manage future liabilities more accurately. Planning in advance ensures that the shift in AIM reliefs does not erode the financial progress built over many years of disciplined saving and investing.
Number 10. Potential reduction of cash ISA allowances and the shift toward risk-based saving. The 10th financial change that could directly impact savings in 2026 is the proposed reduction of the cash ISA allowance, which may cut the current £20,000 annual limit to a noticeably lower figure. Cash ISAs have long been one of the safest and most popular places to store savings without paying tax on interest. Reducing the allowance means people will no longer be able to protect the same amount of cash each year from taxation. Policymakers are signaling that the goal is to push savers toward investment-based ISAs rather than allowing large volumes of tax-free cash to accumulate. If this proposal goes forward, saving in cash while avoiding tax could become much harder than it has been for the past decade. The concern for everyday savers is clear. Many households depend on cash ISAs to grow emergency funds slowly and securely, without risking money in the stock market. A reduced allowance could create competition for safe, tax-free space, forcing people to decide which long-term goals to prioritize. With interest rates still fluctuating, the return on cash savings could fall behind once part of the allowance is removed, driving more savers into products that involve exposure to market volatility. Pension planning, first home savings, and rainy day reserves may all experience new constraints under an allowance cut. At the same time, people who continue saving outside the ISA allowance will face taxable interest, reducing the real value of growth over time. There are ways to prepare before any final announcement is implemented. Savers can maximize the current ISA allowance while it remains available, building a stronger tax-free base. Exploring stocks and shares ISAs, lifetime ISAs, and diversified savings across protective platforms can create balanced growth without relying entirely on cash. Setting up automatic monthly transfers toward ISA accounts prevents allowance space from going unused. Reviewing how much savings remain outside tax shelters also helps identify where interest may become vulnerable in the future. Preparing early gives savers a degree of control over how much of their financial progress is protected if the cash ISA rules change in 2026.
The changes coming in 2026 reveal one clear message:
The old ways of saving money in the UK are evolving, and anyone who continues using the same strategies may face losses without ever making a mistake. Each new rule on taxes, pensions, ISAs, digital payments, investment reliefs, and BNPL shifts the balance of financial security. None of these laws operate loudly or dramatically, yet together they reshape how wealth grows, how it is protected, and how much remains in your hands over time. The people who adapt early will carry the advantage, while those who delay may watch savings weaken slowly without realizing why. Preparing is no longer just about earning more, it is about protecting what has already been earned. Reviewing accounts, diversifying savings, securing tax-sheltered vehicles, and staying aware of regulatory updates can make the difference between financial confidence and financial pressure. Small adjustments now can build long-term resilience before these laws become permanent and unavoidable. If this video helped you understand what is coming, take a moment to support the channel so we can keep creating content that protects viewers from financial risks. Like the video, subscribe, and share your thoughts in the comments. Your voice matters here. Let's stay one step ahead together.